All right. And with that, everyone, again, welcome. Good afternoon. Um, Today's webinar, Cooperative Taxation, Subchapter T, and the IRS. We appreciate you being online for this. Again, my name is Brian Munson. I am the Business Development and Sales Manager for NCBA CLUSA, and I will be today's webinar moderator. The webinar today is co-hosted by NCBA and Wegner CPAs. Before we begin, just a quick bit of housekeeping for you. All participant phone lines will be muted during this presentation to reduce background noise. There will be a chance to pose questions, just not verbally. So if you do have a question, please feel free to type it into the question box on the GoToWebinar control panel that's on your screen. When Bruce is finished, we'll collect the questions and run through those as time allows, and he'll be able to answer those as we can. Lastly, NCBA is recording this webinar, so it will be archived on our website, and you will receive an email containing the link to that posted recording early next week. So you'll be able to share it again with colleagues, friends, interested parties, etc. So today's panelist from Wegner CPAs is Bruce Mayer. Bruce is a partner with Wegner CPAs based in Madison, Wisconsin. He and his firm work with over 120 cooperatives from coast to coast, providing tax, accounting, and financial statement services. Bruce himself specializes in food, worker, and purchasing co-ops. He also works with nonprofits, employee benefit plans, and commercial business. Before we get started, just a quick bit of background on Wegner. Their core philosophies revolve around listening, researching, advising, and implementing solutions that are really designed to guide your cooperative beyond the numbers to achieve success in today's complex economic environment. With over 60 years of experience and a wealth of experience in working with the cooperative business model, they are able to provide basic accounting and tax services, but they also offer genuine insight and fresh thinking when it comes to some of the challenges that your organization might be experiencing. They have a partner and relationship-based approach focused on keeping you competitive, and whether it's helping your leadership manage financial risk, improving performance, or operational effectiveness, NCBA knows that Wegner can provide your co-op with the information that you need to do it best. So with that said, I would like to turn the webinar over to Bruce, and we can get started today. So Bruce, it's all yours.
Okay, thank you, Brian. So as mentioned, the topic today, cooperative taxation. This talk was given originally at the Co-op Professionals Conference that just happened last week in Minneapolis, sponsored by NCBA. And I'll just put in a plug that this is a new conference, but I think it would be very useful for any attorneys or accountants who want to attend, and next year it will be in mid-September in Miami, so certainly a nice place to go, and we do have it qualified for continuing education for both attorneys and for accountants. So, as mentioned, I have quite a bit of experience with co-ops, and primarily in worker and consumer co-ops. And so while most accountants have quite a bit of experience, when they have experience in co-ops with agricultural, rural electric credit unions, I don't really have that experience. And this conference has quite a bit of emphasis on the worker co-ops, consumer co-ops, other things that are not as widely known about. There are also quite a few people who are co-op developers who are interested in this conference, since many of the new co-ops being developed are worker co-ops. There's a lot of growth in that area as opposed to in traditional sorts of co-ops where there's generally more mergers than there are new ones. So I'll start out talking about co-ops, and then we will get into some details. And then just a note on the presentation, as I said, it was given at the Co-op Professionals Conference, and I did that presentation in conjunction with an attorney, George Benson. And so some of the slides have quite a bit of legal references and so on that he wanted to add in, and so I will discuss those here. And certainly if you have any questions, I put my contact information as well as George's at the end. If you need to know something about what's going on with some of these slides, be happy to talk about that more by email or phone in the future. So the first thing to know about co-ops is that it's a form of ownership, and it can be very difficult to talk about co-ops as a general thing when you're talking about service co-ops versus retail versus wholesale versus housing. Those are all very different sorts of businesses, and so the common thread there is the ownership. So in the talk today, we'll talk about federal and state taxation, talk a little bit about incorporation and the effect of the incorporation statutes, the effect of articles and bylaws on how co-ops are taxed. And I'll also mention here P3 or Principle 3 for cooperatives, that many co-ops talk about P6, which is cooperation among cooperatives, but it's really important for us working with co-ops from the business side to remember member economic control. And just the phrase that's here is very important to remember as you're dealing with tax issues for a co-op, that you need to have members contributing equally, democratically controlling the capital of the co-op, and that they benefit in proportion to their business done. And these things are actually codified by the Internal Revenue Service in how they are looked at and taxed, so it's important to keep this in mind as you work with a co-op. Most co-ops have been organized as corporations, and so we'll talk about that. We'll also talk about the LLC co-ops and about nonprofits. And so there are incorporation statutes in quite a few states that apply to co-ops, but often those are only for farmer co-ops or some other sort of co-op that doesn't necessarily fit when you're a worker co-op or a consumer co-op. So you have to look closely when you're going to start up a co-op in a state whether you have the right incorporation statute. You can certainly consider incorporating other states. I run across co-ops that are incorporated in Minnesota and Wisconsin that are operating in other states because these states have good incorporation statutes. You can run afoul of securities rules when you do that. Often there are in-state securities exemptions, so that if you want to have preferred shares or member loans in a state, if you're incorporated in a different state, you may not be able to fall under your in-state exemption, so that's something to consider. But if a co-op is likely never going to be issuing any of those sorts of securities, incorporating in another state can be a useful option. One thing to remember when you are incorporating in states, that you do need to operate on a cooperative basis, and there are a number of citations here about just what that means. And these were useful if you're getting into details of something that may or may not exactly fit in to the rules on a Subchapter T or a corporate co-op, is that you have to make sure you're operating on a cooperative basis, and just exactly what that means. So the IRS goes through a series of tests, the one member, one vote being one of the easier ones to remember, that the profits are allocated on the business done with the members as opposed to based on capital. And so it's a good idea to be familiar with these rules when you're starting up writing the bylaws and so forth. There are some times when people want to start a co-op but maybe are not fitting under these rules, and so you need to be doing research on that. There are now 6 states that offer limited co-op association acts, basically LLC cooperatives. That started with the Minnesota 308B, and there's Wyoming, Wisconsin, a number of other states have these incorporation statutes. So it allows you to start up under basically an LLC form, and so at that point you can decide if you want to be taxed as a corporation or as a partnership. We'll get into that a little bit more in a minute. If you are in a state that does not have one of these rules, or if the rule in your state doesn't really fit what you want to do, for instance, there's one state where you require at least 5 members And so if you have a 3-member worker co-op that wants to start up, you may not be able to do it with that particular incorporation statute. But you can use a general LLC statute and then adopt an operating agreement that will meet the IRS tests for operating as a cooperative. The same thing can be said about starting up a co-op that's going to be a corporation. If you don't have a co-op statute that you like and you don't want to incorporate it in another state, you can use your state's general co-op statute. There are a fair number of co-ops out there that are incorporated in Delaware, just like many other corporations are. And again, you just need to adopt the right bylaws and articles of incorporation to allow you to qualify under the IRS rules as a co-op, and you're good to go. One of the things that I run across on a regular basis is co-ops that are really nonprofits. And so it's important to distinguish that, because a co-op is supposed to fall under those P3 rules where you're sharing profits based on business done. And in a nonprofit, if you're actually operating as a nonprofit, you're obviously not sharing profits. You can't do that in a nonprofit organization. Now, you might be incorporated under a non-stock statute, which was common 20, 30 years ago. Quite a few of the co-ops that I work with started out that way. And so there was no co-op statute, and they didn't feel like they fit under the regular corporate statute, so they did non-stock. This can be very limiting, especially if you want to issue securities, member loans, or preferred shares. You may actually have to reincorporate, which any of you who have experienced that know that it's not a lot of fun to reincorporate, because you have to start over again, essentially. Potentially it will be tax-free, but you'll need to get a new identification number and so forth. And generally, the IRS won't recognize something that's operating as a co-op as being tax exempt. So, but many of the folks that I work with who call themselves co-ops, who are really nonprofits, are really tax exempted. So they're not really operating as a co-op. They're just basically a democratic organization that's doing some sharing function. So one of the key issues is that no matter what sort of co-op, you have to think about what kind of taxes it's going to be paying and the advantages and disadvantages of that. So if you start up one of the new LLC cooperatives, those co-ops have the option of electing to be taxed as a corporation, which we'll talk a little bit more about in a minute. So there are potentially choices as to which one of these you have. If you are an LLC co-op, the assumption is that you're going to file an IRS Form 1065, which is a partnership form. And so in that case, the profits are allocated to the members or partners. They each get a K-1. They will be paying tax on the income in the year that it's earned. So if you had profits in 2014, for instance, everybody gets a K-1 in early 2015, and they put that K-1 onto their personal Form 1040, pay taxes on it for 2014. One of the things that many of the co-op developers and attorneys have been looking at is whether an LLC co-op can be useful for people who don't necessarily qualify to fill out a Form I-9. And so there's a lot of research going on in that area. I don't have any particular opinion about that, but I know that some folks like to have the LLC type co-ops, because the workers in the worker co-ops who are there are not considered employees of an LLC, depending on your state, and so that can be useful for them. The co-ops that are formed as corporations file Form 1120C, the corporate tax return. There's a W-2 for all the owners who work in the business. If there's an allocation of profits, that's done through a patronage dividend, and so a Form 1099-PATR is filed the next year, and so you actually get a deferral of the taxation on those profits when you do that, because a co-op filing an 1120C is profitable in 2014. It will file a 2014 tax return, pay on any tax on income that it retains, but the patronage dividends are allocated in 2015, and the people receiving those, or the companies receiving those, pay tax on those in tax year 2015 as of the date that they receive it. And so there is some tax deferral when you have a corporate form for a co-op, which can be useful. One quick note, when you start up a co-op, and I'll emphasize this again later, it's good to be on an accrual basis when you are in the corporate form, because patronage dividends are not deductible in the year that like say for 2014, if you're on a cash basis, you couldn't deduct your payment of 2015 patronage dividends. So it's important to pay attention to issues like that when you get started and make your initial elections. For the worker co-ops, if they start up under an LLC statute, they may elect to be taxed as a partnership, which is the default, or they can file an election form with the IRS to be taxed as a corporation. So they need to do that at the beginning of the first year that they want to be taxed as a corporation. So for instance, if you were a worker co-op started as an LLC and you started in January of 2015, it's too late now to elect to be taxed as a corporation. You may fall under some forgiveness provisions of the IRS if you want to go that route, but generally speaking, you're not allowed to do it unless you elect at the beginning of the year. And one thing that some co-ops or co-op developers have advocated is that worker co-ops should start up as an LLC and operate that way until they're sure that they're going to be successful, and at that point they can elect to become taxed as a corporation when they decide to become more formal. It's also a point at which the founders can be essentially rewarded or bought out by the corporate co-op, so that you can use preferred shares or some other payout to reward the people for taking the risk to start up a business, and then it can be very helpful later on as you get bigger and more formal to be in the corporate form instead of as an LLC taxed as a partnership. This next slide, actually two slides about 1042, this is related to ESOPs, which is another way to have a co-op that I'm not going to specifically talk about. The reason this is in here is because it's the only place where the IRS talks about what they consider a worker co-op to be. And so they talk about things here about what your board of directors has to look like, how you allocate your earnings. One of the interesting things here is that, for instance, on this slide 2D and E, those things are actually not in harmony with Subchapter T. In Subchapter T, you want all of your board as opposed to the majority of your board to be elected by the members, and you do not allocate your earnings and losses based on capital contributions in a Sub-T co-op. So there's some variance here, which happens periodically with the rulings and so forth with the IRS. But just to note that there is actually a formal definition from the IRS for what a worker co-op looks like, and so that's in 1042. This next slide is a continuation of the details on that. And the last note there, it's good to be cautious when you're looking at these things and make sure that you are following a reasonable interpretation. So when there are profits in a co-op, generally speaking, when those go for distribution, that's done through a patronage dividend. And so how you calculate that is laid out in the IRS, in that it is in IRS code, in that it is proportional to the business done by a patron, and so you want to make sure that you have some basis for how that's done. If it seems at all questionable, that really should be laid out explicitly in your bylaws. And so there's a code site here, the 1388A, that talks about how that's done. In worker co-ops, there's a lot of questions about how you do patronage dividends. There's a citation here to an article by Dmitry Kustov about how you do that in worker co-ops. We'll talk a little bit more about that in the next slide, but it's important to know that worker co-ops and other co-ops may have a little bit different take on that. And the bottom half of this slide has a number of citations to where there were a group of plywood co-ops in the Northwest that that ended up doing or having quite a bit of litigation with the IRS about just exactly what it means to be a worker co-op paying out patronage dividends. And so those are recorded then in the history of how co-ops do that, and so you should take a look at that you know, when you're working in a worker co-op if you want to do anything unusual. As I mentioned, you have to allocate based on the quantity or value of business done, and in a worker co-op the most common way that's done is based on hours, and that is acceptable to the IRS. That's sort of their preferred method of how you would calculate your patronage. So in that case, if everybody in the co-op had worked 10,000 hours and somebody worked 2,000 hours, then they would be getting 20% of the profit allocated to them. If anybody in that group of 10,000 was not eligible for whatever reason, they hadn't been there long enough, they're not actually a member of the co-op yet, then that portion of the profit, whatever that would be taxed to the co-op, would not be distributed to the other worker owners. Some of that litigation with the plywood co-ops, they wanted to pay out their patronage dividends based on something other than hours. They were using multipliers for experience, and so they felt that the profits were more due to their experienced members, who were mostly members of the co-op, as opposed to their newer workers who often were not members of the co-op, and they wanted to apply some factors to do that, and they had that litigation with the IRS because initially the IRS didn't agree. Ultimately they prevailed on that. However, you need to have a very strong justification, and so when I talk to co-ops, I recommend that they use hours and then use bonuses or some other method of compensating people for you know, differentials in experience in the co-op. But again, you can explore using those other things, and there is justification for doing that. You just want to make sure that you are clear on how you're going to be doing that in advance and that you have a good justification. A big topic in the worker co-ops is how a patronage dividend should be taxed. There's no question that the patronage dividend is subject to income tax. The question is about whether it is subject to self-employment tax or not. And there is a good deal of uncertainty in that area. There's a note here about an attorney, Gregory Wilson, did an analysis of this. In farmer co-ops, it's clear that if a farmer gets a patronage dividend and they're actively engaged in farming, that patronage dividend is subject to self-employment tax. If you're in a worker co-op, it's not clear. And so what I've come up with, which has no particular justification other than you know, that other people have used it, is the S corporation rules, which you may be familiar with, where in an S corporation the owners get W-2s and then the profits are allocated to them, and if those profits are not significant, the IRS will not make them subject to self-employment tax. If those allocations of profits are more than about 25% of someone's compensation, assuming that compensation is fair to begin with, then the IRS would generally consider challenging the level of profit allocation versus W-2. So in applied to a worker co-op, if somebody takes 100% of their compensation through a patronage dividend as opposed to getting a W-2 in a corporate form of co-op, then they most certainly should be subject to self-employment tax. If they take less than 25% of their compensation, then you at least have a justification for not having that subject to self-employment tax. So just know that this is not a settled area, and you should have justification and a method for how you're determining what the taxation should be on your patronage dividends in a worker co-op that's a corporation. And I will back up and say that in a worker co-op that's an LLC, taxed as a partnership, and everybody gets a K-1, then 100% of the income on that K-1 is going to be subject to self-employment tax. That's very clear under the partnership rules. And so that's another place where being taxed as a partnership may be somewhat less advantageous tax-wise than being taxed as a corporation. If there are patronage dividends in an LLC co-op, that would be done through just the general allocation of profits in the co-op, so that you can, in an operating agreement of a partnership, you can allocate profits most any way that everybody will agree on, and the IRS is fine with that as long as you have it laid out. And so if you do it based on hours and so forth, that works. You just have to make sure that you have it indicated in advance in your operating agreement. Another interesting area of co-ops that's been becoming more popular is multiple stakeholder co-ops. So what that is a co-op that has two different ownership classes. For instance, in a retail food cooperative, the workers might be one of the sets of owners and the shoppers the other set. In most retail food co-ops, the shoppers are the only owners, but you could have one where they have shoppers and workers are both there, and there can be, I think I've seen as many as 3 or 4 classes of owners in a co-op. One of the classic examples that's out there is actually a bit like a CSA. It's a fishing co-op where the people who were doing the fishing, catching fish, and the consumers were both in that, and so the people fishing delivered fish, and then the consumers bought the fish, and they were both considered owners of that co-op. Typically, these multiple stakeholder co-ops are set up so that there's not much profit at the co-op level, but if there is, then you want to make sure that you have thought in advance about how you're going to do that. Obviously, when you have 2 different classes of owners like this, they have competing interests that may be in conflict if there's a lot of profit, and so you want to make sure that you have thought about what the basis will be. In some cases, for instance, the fishing co-op, there's fish in and fish out, and you could look at how you allocate profit based on that to some extent. If it's a retail food co-op and you have workers and shoppers, they're obviously doing different things. The workers are providing hours of labor, the shoppers are buying product, and so you can't come up with a really good formula. So typically in those multiple stakeholder co-ops, I recommend that they decide in advance. For instance, in the retail food co-op, maybe they are 50-50 owners of that co-op, and so 50% of the profits go into calculating the allocation to the workers, 50% of the profits go into allocating profits to the shoppers. But it's important to do that in advance, and also to know that there's very little guidance from the Internal Revenue Service. I think you want to be pretty clear if you were looked at by the IRS that you did this all deliberately, and that it all makes economic sense. And speaking of the IRS, a quick review of dealings with the IRS is important. There's a lot of uncertainty in the co-op area because there is not a lot of litigation and definition of things. One of the reasons that that's the case is that there are relatively few cooperatives out there, and so it's not necessarily worth the IRS's time to spend a lot of time, and with so few co-ops, there's not going to be nearly as much litigation as there is in other entities. The National Society of Accountants for Co-ops releases the IRS numbers each year, and there are so far fewer than 9,000 Form 1120C filings per year. There's no good way to count the LLC co-ops, but there are relatively few of those. So probably there's under 9,000 co-ops filing tax returns each year, and obviously that's a very small number of taxpayers compared to individuals or LLCs or most any other form. So because of this lack of attention by the IRS, there's no e-filing allowed, so your 1120C is required to be paper filed, which these days can cause all kinds of problems. Not to be able to e-file it and have a definite record of it being accepted by the IRS. There's no dedicated tax payment identification, so when the taxpayer goes to pay their taxes, they have to check the 1120 box. There's no 1120C box. Occasionally the IRS will put those payments in the wrong place, and it can be quite a challenge to get those reallocated to where they're supposed to be. There are, however, a small group of co-op specialists at the IRS, and of course they spend most of their time on the large agricultural co-ops because that's where the money is. But there are folks who do that. If you encounter a field IRS agent, they're very unlikely to know anything about what a co-op is. But the IRS does know about co-ops. There are just not very many people who do. And also with the IRS code, we talk a lot about Subchapter T, but it took me a number of years working in co-ops before I really realized exactly how small Subchapter T was. So now I try and get all my staff to read it. It's something that you could read in an afternoon. I would treat it like reading some sort of a poetry or something like that, because you have to reread the lines several times to understand what they're trying to get at. But it's not very long. It's I don't know how many pages it is, but it's not much more than 50. And those are the code sections and what each one is about. There are some regulations that might double the size of all that. But again, those regulations are pretty narrow in reinterpreting these code sections. So I suggest everybody take a look at that. There is a lot of history involved in co-ops, and so a lot of the co-op rules have evolved over time. There are several good research sources. One of them is that USDA pamphlet mentioned. That's a good historical document. And then Tax Management Portfolio 744. I have a printout of that I keep in my office and I look at on a regular basis. It's not cheap. I think the standalone price for buying that is like $400, but if you're already subscribing, that's something you want to take a look at. Wherever you get your information, it's important to have that source have looked at all the court cases, because many of the rules we have now are a result of litigation that happened 50 years ago. And so it's not something that will necessarily pop up if you're just casually searching for it. A quick note on the information reporting requirements of a cooperative. If a cooperative has a Form 1099 PATR, they have to be issued if patronage dividends were paid for $10 or more. They don't have to go out to corporations, just like other 1099s generally are not issued to corporate recipients, but you do need to pay them out if it's an LLC or an individual who for whom that is taxable. There is an exemption for consumer co-ops, so if you are a retail food co-op and you pay a patronage dividend to your members, generally speaking, you will not have to send the 1099 PATR, and the rules on that exemption are outlined here. It makes a lot of sense since the recipients have an exemption from paying tax because they were purchasing the items for personal use, that they would not then have tax on it, and so it doesn't make sense to send out a 1099 on that. One of the questions that comes up quite a bit with worker co-ops and small co-ops of all kinds is about capitalization. It's a question I get from attorneys regularly, is about, how do we deal with the equity section? It's one of the only areas in the income and balance sheet, income statement and balance sheet of a co-op that's different from other kinds of businesses. And so you have the owner equity section where you have the shares purchased, you have any patronage dividends that somebody as an owner has been allocated that have been retained by the co-op are there. One of the things that you want to make sure is in the bylaws is that that these really are equity. If you have a specific obligation to pay these out, then it can become a liability, go in a different part of your balance sheet than if it's truly equity. One of the things that the co-op needs to do to keep it as equity is to reserve the right not to pay it out based on a decision of the board. A big question that comes up, unallocated retained earnings, also called indivisible reserves. In the corporate form, this is easy because that's your retained earnings. So if you decide to have some unallocated retained earnings, indivisible reserves in a corporation co-op, you just pay tax on that. It goes into retained earnings, and you move forward with that, basically controlled by the co-op as opposed to individuals. Otherwise, you allocate patronage dividends and retain part of it, and then that belongs with the owner equity. It's not part of the basically the co-op's own equity. In a partnership, there's a lot of discussion about how to create indivisible reserves. Under the tax laws as a partnership, there's no good way to do that because all income is taxed to the partners and not to the partnership, and so there's really no money that essentially belongs to the partnership. You can finesse this in your operating agreement, but essentially what you have to do is owners have to agree that when they go to leave the partnership, they have to leave behind part of the profits that they paid tax on in the past, and so they will have perhaps some sort of tax relief when they have that loss on leaving behind part of their equity. But it's not a natural thing in a partnership to be leaving behind some of your equity, and so you have to make sure you've thought a lot about that in drafting documents to get the partnership started. One of the questions in a corporate form, if you have the indivisible reserves or unallocated retained earnings, is the fairness of that. If people go to leave the co-op in the future and say, hey, I helped to earn that money, I want to take that with me, you want to make sure that you had a clear policy about that, that some of those profits were intended to stay in the co-op to ensure its long-term survival. In Europe, there are actually rules around indivisible reserves where co-ops are required to set aside a small percentage, maybe 1, 2, 3%, and the idea is to ensure the long-term viability of the co-op. Is if people are leaving and taking a lot of their equity with them, then the co-op may not be able to survive if a lot of people are trying to leave at the same time. In co-ops, two of the big ways that they are capitalized through preferred shares and then through owner loans. Especially if a co-op is small, it can be difficult to obtain outside financing. One of the things to remember with preferred share capitalization is that any dividends you pay on those preferred shares are non-deductible to the co-op, and so that makes it a little bit more expensive than owner loans, where the interest is of course deductible to the co-op. So you want to make sure you've thought about that in advance. Also, you have to take a look at your state rules on preferred share dividends or also on interest paid to owners. There's generally a limitation of 8%, although it can vary on paying that out. Of course, these days nobody's going to be paying more than 8%, but it is often a statutory limitation for co-ops to be able to pay only that much. The idea being that the profits should be held for the owners doing business with the co-op as opposed to for those who are just investing capital in the co-op. Another question that comes up with startup co-ops is about what they need to keep track of that's different than other businesses. And so the equity section, again, is the main area where you have a difference with other businesses. Typically, most small businesses have one or a very small handful of owners. Co-ops can have many owners, and you do need to keep track of the equity investment of each one of those owners. So if you just have a few, you could potentially create an account for each person in your accounting software, and that's a pretty easy place to keep track of that. If you have more than a handful of owners, then a spreadsheet is potentially good. If you have a few dozen owners, keeping track of all of their equity investments and then making sure that ties out to your accounting software. And then when you get into the many owner situation, such as a food co-op has, where you might have thousands or tens of thousands of owners, obviously you want to go to something readily searchable and not prone to calculation problems like a spreadsheet can be with a bad formula somewhere. So you want to make sure from the start that you are keeping track of all of that in the co-op, that you know what all the people invested. And then as far as the patronage dividends paid, you do need to keep track of that if you retain any of it in the name of each recipient indefinitely. When you pay patronage dividends, you can decide that some people will or will not get them. Even though everybody's a patron, some of those patrons may not be eligible, and you can decide that. Hopefully that's laid out in your bylaws or a policy so that you know who is or is not getting patronage dividends in advance. There are a lot of rules laid out in the IRS code about how you have to specifically structure patronage dividends. They need to be paid within 8.5 months of your year end. If they're paid after that, they are not qualified as patronage dividends. You can pay out qualified or non-qualified patronage dividends. Qualified generally being taxable and non-qualified generally being non-taxable at the time they're awarded, and they potentially become taxable when cash is paid later. It's important to remember that if you pay a patronage dividend and you do not pay it all out in cash, that the non-cash portion is taxable, and so that can be a source of consternation to your owners if you're allocating them $10,000 and you only give them $2,000 in cash, and they still have to pay tax on the whole $10,000. So you want to make sure you're paying attention to those issues as to who's paying tax, and that the members understand that they will be paying tax on that. That's a source, I think, of a lot of issues in the tax code in the past. Is whether something is taxable to the individual even though they didn't get the cash. There is also a new IRS rule that you can notify your members electronically. There is a requirement that each member be individually notified that they have a patronage dividend and what it is and that it's taxable. The IRS now has some rules laid out in a private letter ruling about how you can do that electronically. As is often the case with private letter rulings, the IRS recommendations are pretty tight, making sure that each person, that each person got that notification. But it is possible now to not have to send out paper for all of that, so that's a good thing. And then the last slide I have here is about your accounting system and how you deal with things like receiving patronage dividends. If you're a co-op, you may well be a member of other co-ops, or if you're advising your members, you have to make sure that they understand how that patronage dividend is done. In your accounting system, you want to make sure that you're keeping track of the business done with or for patrons. so that you can do your patronage dividends at the end of the year. So you have to decide, is this based on volume of business, units of business, hours, whatever it is, you have to make sure that you're going to be able to capture that so that at the end of the year you can come up with an allocation of the profits that's based on what the rules are for your co-op. And again, if you have profits and you are not going to pay out part of it because, for instance, very few co-ops pay out profits to non-members, although they are eligible to do so under the IRS code. Very few do it. They want to encourage people to become members. So if you have non-members that you've done business with, any earnings that you had with them will be taxable. And one distinction to make is that non-members and non-patronage are not necessarily the same thing. This is potentially a big topic, but it's something to think about, is that if you're, for instance, if you have a retail food store, everybody who comes in there as a patron, they would all be eligible for a patronage dividend if you decided to pay them. Pay that out to them. Of course, you're not keeping track of all those non-members in your point of sale cash register system, so you couldn't pay it out. But theoretically, if they brought in their receipts, you could pay them a small percentage of the receipts they produce, and give them a patronage dividend that way. So that's not non-patronage activity. Non-patronage activity is generally investments in outside activities meant to earn a profit for the co-op as opposed to being part of your core business. If you want to look at this a little bit more, you can look at the definition the IRS gives to non-patronage activity in the 1120C instructions, and just make sure that you are doing that correctly. If you have business activities that are not done with or for your patrons, potentially they are non-patronage. And then just one final thing on that, there is often confusion with the agricultural co-ops, because often those exempt agricultural co-ops only deal with members, and so for them, member, non-member, and patronage, non-patronage are synonymous. But for other non-exempt co-ops, that's not the case, so you just have to be sure you think about that and remember some things you read about co-ops. It may be a little bit misleading if you don't understand all of the context involved. So, as I mentioned, I had done this presentation at the Co-op Professionals Conference last week in Minneapolis, and I had done it there in conjunction with George Benson, an attorney, and so this is the contact information for us. And if there's any questions, I'm happy to entertain those.
Hey, Bruce, thanks again for that. We do actually have a couple questions. I know we have about 12 minutes left in this hour, so we'll just get right into those. The first question is, why have so many food co-ops moved into 501c3 status?
I don't believe that they have. They may start up a foundation that would be a 501c3, but food co-ops are definitely not 501c3, because that's 501c3 is the IRS charitable organization statute, and so I don't believe that that's the case.
Okay. Next question we have, worker co-op members based in several states. Do they each pay income tax on total patronage retained and distributed in their own states or in the state of incorporation?
That's a good question. So, and that's actually something I didn't talk about here, but it depends on whether you are a co-op tax as a partnership or a co-op tax as a corporation. If you're taxed as a partnership and you're in multiple states, the partnership files in each of those states where you have an owner that's actively engaged in the business. And then each of the owners will also have to file in each of those states. So everybody gets a K-1 for the federal purposes to file with their 1040, but then they also get a K-1 from each state where the co-op operates. So you end up, if you had a co-op that was in, say, California and New York, as an individual owner of that worker co-op, the co-op would file in in California and New York, and then each individual owner would also file in California and New York. If you're a corporation filing 1120C, the corporation would file in each of the states. So in this instance, the corporation files in California and in New York, but each of the co-op owners only files in the state that they live in. So it's simplified when you're in the corporate form.
Great. Another question regarding multi-stakeholder co-ops. How do the employees fit into the partnership structure?
Multi-stakeholder co-ops, I think, would be really hard to do in a partnership. So I've not seen one that's been done that way. They've all been corporations that I've worked with, and the problem there would be, everybody would be a partner and get a K-1, and typically at least one of those stakeholder groups is fairly large and may not actually have taxable activity. But if it's a partnership and they all get a K-1, it's definitely all taxable at that point. So potentially you're creating tax situation for some of your some of those stakeholder groups that you wouldn't have if you were a corporation. For instance, if you have a multiple stakeholder corporation and you have the people fishing and the consumers, on the consumer side, they wouldn't have any taxable activities with the co-op because they're purchasing fish for personal consumption, whereas the people fishing do have taxable transactions with the co-op. So I would definitely suggest not doing a partnership in a multi-stakeholder co-op situation.
Great. Next question. This person is curious about the analysis for S corporations and worker co-ops. Is your understanding that worker members can get a W-2 and their patronage dividends are subject to ordinary income tax and not self-employment tax?
Yeah, certainly doing an S corporation complicates things a little bit because you're not really under the Subchapter T rules at that point. You're under Subchapter S, the S corporations, and so in that case you wouldn't have to do a 1099 PATR. And in fact, I'm not sure there would be a good way to do that because you could deduct it on the S corp return. But I would suggest that you would just do your allocations of profits in that case through the normal S corporation method. The problem there being that in S corporations you're required to do it based on ownership. So I don't think an S corporation is a really good form for a worker co-op. But to the SE question, I think that as I mentioned, if the amount of the profit allocation is relatively small, meaning generally speaking less than 25% of total compensation, then it would not be subject to the SE tax. But again, you have to pay attention to whether the compensation is fair or not for the individuals. But I think that would be the case.
Got it. And on kind of a related question, the advantages of Subchapter T over a nonprofit?
Again, if you form a nonprofit, then you're not sharing profits because a true nonprofit is tax exempt with the IRS, and so you're not allowed to share profits with individuals. And everybody in a nonprofit situation would be getting a W-2. And so there can be an advantage to having the nonprofit form if it works for you, because any profits of the corporation would not be subject to tax, but then you can't then distribute them to anybody. You have to use them only for the exempt purposes of the organization. So in a sub-T, the people working with the co-op are in more of an ownership relationship, and so there is the potential for sharing profits and so on. So, and again, on all of these questions, you have my email address there. I'm happy to take a phone call or email back and forth. It can be hard to fully answer a question when you can't do follow-ups.
Sure, absolutely. At one point, I think you had mentioned, there was some confusion around sometimes co-ops aren't really cooperatives, and so there's opportunities to help clarify that. Just in terms of the co-op professionals group, do you have a sense of what the group is doing to sort of help protect the co-op business model alongside NCBA that you could talk about?
Sure. And the co-op professionals group at this point is a majority of attorneys, and so one of the things that they're doing is working on some uniform co-op statutes to try and get states in line with each other. One of the problems, and one of the reasons that people end up forming nonprofits in some states is because the co-op statute is not satisfactory. And so I think that that's one of the big initiatives for this coming year. And if anybody on this call is an attorney and would be interested in looking at the Uniform Co-op Statute or an analysis um, of their own state's co-op statute, should certainly get in touch with NCBA. They have a project this year to look at all of the states, and the USDA is going to republish a guide that was published quite a few years ago analyzing all of the state incorporation statutes.
Great. Yeah, that's one of the folks at NCBA that they would want to contact is Suzanne Rogers. Her email, if you guys are looking to learn more about that, is srogers, Rogers, at ncba.coop. It looks like that's all of the questions that we have. Bruce, any sort of final words, anything that you'd like to leave the attendees with?
No, I think I covered everything. It was all very brief. As I said, I'm sure you'll have additional questions. Feel free to send me an email, and then also think about coming to Miami next year.
Absolutely. Yeah, we'd love for everybody on this call to join us there. It's a growing and diverse group, and we've just started to put some of this stuff in place. And so on the NCBA side, we're very excited about this. Um, Again, Bruce, we've had a couple questions for these. Will your slides be available or no?
Oh yeah, sure.
Okay.
Yeah, if somebody emails me, I'd be happy to send you my slides.
Okay. Wonderful.
They were in the conference packet for the Co-op Professionals Conference as well.
Correct. Okay, awesome. So hopefully that answers. There's a couple folks that were looking for those. So again, thank you to Bruce for preparing this session for us. As I mentioned at the beginning, this has been recorded. We'll make sure that we get you that link within the next few days. If you're looking to learn more about the Co-op Professionals Group, as I mentioned, Suzanne Rogers, you can reach out to her at srogers at ncba.coop. You can also plan to join us in Miami next fall, September 19th through the 21st for the Co-op Professionals Conference. That conference, as Bruce mentioned, will focus on providing accredited learning certifications for both lawyers and accountants on topics like taxation, ethics, regulation, compliance, business planning, finance, securities, and much more. If you are interested in becoming a member of NCBA CLUSA, you can reach out to Thomas Bowen at tbowen@ncba.coop. Thomas is standing by waiting to hear from you guys. And again, to stay in the loop on all things co-op, make sure you're subscribing to the Co-op Business Journal and that you are friends or that you've liked our Facebook page, facebook.com/ncbaclusa. It's been my pleasure to moderate today's webinar. Thank you again for your time, Bruce, and for the audience for your attention and questions.